Ladies and gentlemen, good morning. Let us very quickly review the very little that happened last week. As usual, we will start with the short end of the dollar yield curve. The 2-year basically did nothing, stayed throughout the week in our neutral zone between 109.08 and 109.12, which is indicative of a market which is, of course, searching for direction. Next week we have the Yellen speech in Wyoming, Jackson Hole, which could be quite interesting. And those will be the levels that we watch for the anchoring of the yield curve, 109.08 and 109.12. The 5-year note, much the same, stayed in the neutral zone. And here the levels are 121.08 against 121.20, let's call it. These are the levels which the market has to break convincingly to decide where the next move is going to come from. In the 10-year note, we have again the neutral zone, which is being tested on the upside and on the downside. We now feel that 131.20 is going to be of extreme importance to the market. If it breaks, we are looking for moves potentially all the way down to 129 in the 10-year note. On the other hand, if it cannot sustain pushes below 131, 19, 20, 16, we are likely to go and test the 133.16 level at some stage. What is our favored direction? Well, we are in many minds, and we don't mind telling you that we are pretty clueless. Every time we get bearish, the market bounces. Every time we get bullish, the market drops. So the best that we can say is that it's a trading market. We will go with the break when it comes. Schatz, it's just trading in a 3-4 tick range. There's absolutely nothing to be said for it. So the short end of the euro curve is absolutely dead. The bobble is slightly more bearish, but very much not even testing the very important 133, 21, 22 area that it has to break to make to determine a change in trend. We are leaving it well alone, and in the bunds, absolutely the same story. It is very much stuck in this 80 tick range, which is basically a 10 basis points range. It's trading between 0 and -10 in yield. Until it breaks this area, there's very little to be said for it. It tried several times on the upside and on the downside, and every time it has failed. The indicators are absolutely neutral. There's not a lot to be said for it. We have tried the upside, we have tried the downside. We cannot make our minds up in the slightest here. Until it does, I think the best thing to do is to leave it alone and just job it, which we've been doing, for a few ticks here and there. Looking at the other indicators, the dollar index is coming to a very important level at 93.80. 93.80 with naturally possibility of spikes slightly lower to 93.40, 50. We have a gap here at 93.50ish, which hopefully we shall go and fill. Might get some people very bearish here and then bounce, but that is basically what is going on in the dollar. The dollar is certainly in a weaker phase, and we shall see later on how that is reflected in the equity performances, but certainly in a weaker phase, and we are certainly sellers of rallies in the DX. The other contracts, even the pound has managed to break its very continued downtrend and go back into basically a trading range. 2 weeks ago the pound was getting sold against absolutely everything, and now we can quite easily say that it's going to be stuck in a 128.50 against the 133, 134 range on the upside, without certainly without, we don't see it breaking out for possibly 3 or 4 weeks until we get some better indication of data out of the UK. We are no longer hugely bearish on the pound. We think that it will have squeezes on the upside. On the hourlies that can be best seen, this kind of behavior will no longer happen. We will have trading both up, two-way trading, and squeezes, because the market is very short, all the way up towards the 133, 134, 135 area, which we think for the time being are very good shorts. Well, what has been going on in the equity markets? Absolutely nothing. If you have a look at ES, this is an hourly chart. It has basically traded in a range between 21.65 and 21.85 all week. A 1% range in a week is quite something. The story continues. The bears just cannot force any kind of action on the downside, and the bulls are having very tough time pushing it above 21.90. The dailies are opening up on the upside, and we certainly feel that this market, before it tops, and when we say tops, we mean tops for a week or 2 or 3, is going to need a decent spike, probably well above 2200, to clear out all the shorts and all the bears and get everybody long and bullish right at the top, and then probably come back down towards the 2150 or 2125 area and retest the break area. We just don't see any chance of selling from these levels achieving the desired effect. So we are, if anything, buyers of the ES on dips. But we have spotted some strange behavior, some strange relationship between ES stocks and DAX, and when we see that, we like to step back and have a look at the weekly and monthly picture, and that is what we shall be doing next, to give you an idea of what is likely to happen over the course of the next several weeks going into autumn, when traders get back to their desks and start putting on serious positions. So we shall do that now. This is the same chart of ES on the weeklies, but let us do something slightly different. And let's take away the Bollinger Bands, and let's take away the MACD and just leave the moving averages, and let's see what happens when we remove price. These are the very short-term moving averages. These are the 4 and 12 week moving averages here, and these are the 20, 30, 40, 50 week moving averages below, and that is the 200 week moving average. We can see a consistent basing pattern, much like at these inflection points in the longer term moving averages, and they're all congregating and bunching around the 2050 area, i.e. about 5 to 6% lower below the market. In about 2 or 3 weeks time, they will have gained certainly this kind of level, which is the 2080 level, and will be providing support there. We shall compare and contrast this behavior of ES to the behavior of the other equity indices and ask ourselves why that might be happening. So here you have the ES and its look on the moving averages. Let us now compare that to stocks. As you know, the system, the very long-term system, has been a consistent seller of stocks above, and it has managed to actually go flat. This is the, well, we hope you can see it. Let's actually enlarge it and show you the picture of the moving averages on the stocks. Downtrend, downtrend, downtrend. They are all in a downtrend. This tells us that before this market can make a sustained push higher, we need much more consolidation around the 3000 to 3100 level, if probably several weeks of it. DAX will be stocks will be a consistent underperformer on the upside while this technical picture persists. Let's put price back in there, and let's show you again what we mean. The stocks last week gave up best part of 3%, while the ES did absolutely nothing. So that is what this kind of difference that we are telling you about. This is likely to persist. We are likely to have this kind of trading range in here for the best part of at least another month. Let us compare that now to the DAX picture. And this is the weekly DAX. Let us take away the price so it's slightly clearer. Look at the behavior of the moving averages here. This is a market which is telling you that any pullback towards the 10,100, 10,200 area is likely to be bought heavily. It is beginning to take the same look as here and here before we had at least 1,000 point or even 2 or 3,000 point runs. This gives us a dilemma. Why should the stocks underperform the DAX so much? And all that actually tells us is that Italy and Italian banks are going to have severe difficulties in the next few months. As you know, we have a referendum coming up in the fall in Italy, and that is probably the reason why the stocks is going to underperform the DAX and the ES so much over the course of the next few, at least 10 weeks. So we have our trade: long DAX, short the stocks, and long the ES. This kind of behavior is very indicative of a market which will make probably new highs within the next, let's call it 6 to 9 months. So we are beginning to be very, very bullish DAX and quite bullish ES. This kind of, again, this behavior is being also shown in the weekly picture of the emerging markets. Again, taking away the price and just looking at the weekly moving averages, we have a very nice turn at this level, which tells us that any drop back, and let's now put price back in, any drop towards the 3620 to 3420 area in this box is a very, very good buy for a very large wave, which we suspect will take it at least towards the 45 area. That is a 25-30% move. That is the trade that we will be concentrating on over the course of the next few weeks. Let us in fact look how that matches with DX and gold, because if all these markets are interrelated, we can now see the DX is, for the first time in several weeks, beginning to take at least a neutral to bearish stance. The 96.50 area is providing huge resistance on the moving averages. The DX might, for a couple of weeks, retrace and retest above 95.60, but it looks to us that it's beginning to take the characteristics of a longer term sell, and that is also reflected in the euro, which would make sense, because if the DAX can withstand higher euro prices, Italy, Spain, France probably cannot. This is again the weekly euro. Let us now remove the price, and we can see how the moving averages have begun to change. We have the shortest moving average now at the top, and the longer term moving averages beginning to change their shape, and we have a pretty interesting cross here on the MACD. This tells us that after several weeks of doing absolutely nothing, we could have a very strong rally in the euro up towards the 120 area. So that could be a game changer for ES, because it will definitely rally on the back of that. The DAX might go up the least, but we could have a complete falling apart of the stocks. So again, this confirms the trade. Let's see if the gold chart is any clearer to us. And we think that gold is confirming the trade as well. It is not busting through this trend line, but what it is doing is consolidating right above these longer term moving average. These are weekly charts, don't forget, and we are possibly going to get a pullback in gold as we get a pullback in the dollar over the next 3-4 weeks. But then this kind of 2090 down to 20, probably will be 2050 area, could be a huge buy for the next leg up in gold. So we have another market which is confirming our theory that the dollar will in a few weeks time turn lower, which will push gold higher, and we could also have some big move in relative equity prices, with the US and Germany certainly outperforming the stocks. And the final piece of the puzzle would then be Nikkei. We have done the same thing on the Nikkei, and let's take away the price. Nikkei is much more reminiscent of the stocks chart, with these shorter term moving averages still in a downtrend, and with the shortest moving average only now just turning but at the bottom. So what this is saying is that the Nikkei and the stocks are more or less in the same technical position, i.e. the weakest position, while the ES and the DAX are in the strongest technical position. If you compare this area here, it is nothing like this area here. Absolutely nothing like. So while the Nikkei will certainly have support around the 16,000 area, the up thrusts are going to be probably the weakest, with 18,000 certainly containing it, while the ES might make much higher highs more rapidly. If you look at this picture, and this is the ES, we could have a prolonged period of higher prices, and that is certainly something that we are not seeing at the moment in either the Nikkei or the stocks, but are beginning to see in the DAX. If you draw that for yourselves, you will, in fact, DAX cash, you will see that this is, to us, the beginnings of a bull market in DAX. So that is probably, of course, all bets are off if it trades much below 10,000 and stays there, but this is a picture that we're beginning to really like, and probably looking for the market to make new highs towards the 13,000-14,000 area in the next 3 to 6 months. Let us have a look at what is ahead of us in this week, which might be important for the markets. Monday there is absolutely nothing. On Tuesday, we have German manufacturing PMI, which could be very important for the DAX. And in the US, we have new home sales, which we doubt will really move the market. The whole week has existing home sales and other sort of marginal data from the US. The Thursday we have German IFO business climate, which could be again important for the DAX and give it another push higher. But we just don't think that any of these are going to be as important as the speech that we have, GDP, the first revision for the second quarter out of the States, whether it's zero point 0.1 higher, zero point 0.1 lower, we just don't think that's going to be very important. What's much more important is Friday and Yellen's speech at Jackson Hole. The market will be on tenterhooks for that, because if she comes up with a "we shall hike rates" speech, when has she ever done that? On the other hand, the bond market will be ready to give us a complete puke. We don't think that's going to happen. We think the market will probably get short into it and then squeezed again. And we say short of everything, short of bonds, short of equities, and the move on Friday is, if Wednesday and Thursday have been people putting on defensive positions, is much more likely to be on the upside than on the downside, but we shall see and be able to react. If we just have a look, very quickly look at the yields, this is the 10-year note. It is interesting because it's been trading 150, 160, what you want to do, for the best part of 2 weeks. That can't last, we feel, beyond next Friday and the Yellen speech. So either we are going to have much higher yields going towards the 175 area, so which is what we showed you, around 129 in the 10-year note, or this wedge is going to break on the downside and we're going to cascade back towards the 140 area. But certainly we feel towards the end of next week we shall have range expansion in this very tight 10 basis point yield range that we've been having. The Germans, exactly the same. If you have a look here, zero yield to 10 basis points, what do you want to do? And we've been in this range now for 2 months. This is beginning to be unsustainable. We shall definitely have some pretty large moves in the next few weeks. The one which is actually the most interesting is the Japanese bond. The fact that it hasn't been able to regain any of these huge yield losses that it sustained on the Kuroda and Abe speeches and actions over the past couple of weeks tells us that this market is probably beginning to get ready to break on the upside. Not right now, but in a few weeks' time, which would again probably be the signal for a big correction in all the bond markets, which could push the equity markets down 3 to 4%. So that is the way that we are feeling about that market. In terms of S&P forward earnings and valuations, the fundamentals, absolutely nothing has changed for the nth week. We're still very tight against the 17 times multiple, and absolutely nothing has changed in the sectors. The discretionary has still more room to the upside than the staples, unless the market gets very defensive. The energy index, while technically is looking very good on individual shares, and we have certainly bought some in the past a couple of days is one which is best left alone in terms of long-term investing, and the financials also are still very, very prone to accidents. What does that tell us about the yield curve and relative movements? It tells us that everyone is very, very, very indecisive. If now the financial starts breaking upwards violently, the chances for the bond market to fall apart and the yield curve to steepen are increase exponentially. So this is something that we'll be watching very closely next week. Our favored sectors of healthcare and technology are still the ones which fundamentally are the most justified. The shape and slope of the upward revisions in expectations of forward earnings justifies much higher prices in both healthcare, not so much in industrials, but certainly in technology. Look at these pushes well above the previous highs, and the market is responding to them. It is slowly consolidating in this area, but we feel that over the course of the next few months, technology and healthcare are still the places to be and the places that we would like to buy most on pullbacks. Everything else is very much as it was, apart from telecommunications, which have finally started giving up something, which is an indication of what the market expects the bond market to do, and certainly utilities, which is an even better expectation of what the market expects from the bond market. Utilities are telling us the bond market is in a bearish phase. We don't see it as yet. It needs confirmation, which will probably come sometime on Friday, or not. So we are not sellers of utilities. We're certainly not buyers of utilities, because certainly we think there's more bang for your buck in playing the bond markets. But we're watching this very, very carefully to see what the next move will be in the bond market, because, as you know, we believe that the bond market determines ultimately the valuation of all other assets. That is unfortunately all we have for this week. It'll be another quiet trading week, certainly the first half, Monday, Tuesday, Wednesday, and then we should start getting some action as people prepare for Friday and Janet Yellen, which might be a complete non-event, but certainly the market will prepare itself for it. Okay, thank you very much indeed, and see you next week.